Hey, and welcome back to Artsy Theory. We talk about using art as an investment today. We first talk rather broadly about the art market, then about owning art, and for the main part, I will talk about investing without owning. So in particular, I was interested in the NYC-based company model Masterworks.io. And no, this video is not sponsored. First off, I want to create a bit of differentiation as a base for this video. Talking about art does not equal talking about the art market, nor is it the same as seeing art as an investment tool. You can talk about art without talking about art markets. The reasons someone becomes an artist are not the same as why someone wants to invest in art or start a gallery or go visit a museum. You can be interested in art investment tools to make money through funds without liking art itself, and the other way around. My point is, neither are bad things by themselves, and bad behavior in one sector does not define the art industry as a whole either. Right, so having said all that, we jump right into it. Now, an art investment is considered an alternative investment. These are high-risk investments that are more or less speculative by nature. And the pitch is, there are indeed many ways how to invest in art. For this video, I use three different simplified approaches. Either you own the whole piece, you own a part of a piece, or you don't own the piece at all. And it doesn't matter if it's digital, physical, or any other format. With that being said, it should be fairly obvious that I will not give you any investment advice whatsoever, and I suggest that you only ever invest in something that you actually understand. We first have to start with the art market, obviously. So the place where art is being sold and bought and prices are made is called the art market. The transaction can be either private or public. A private selling is usually a gallery or an artist to collector transaction. And public means having an exhibition where you can buy a piece, or, the ever-famous art auctions we hear in media about from time to time, with often fairly similar observations. Now, if you look at the art market today, in 2020, we saw an interesting shift happening. In these numbers, we saw an increase of high-priced pieces and a decrease of low-priced artist pieces being sold. So also a bit of concentration of high-priced pieces that are being sold by fewer galleries. These datasets are difficult to analyze because privately sold items are not listed in these statistics. Thus only selected numbers and only publicly available data are analyzed. What is true, however, is that the art market is relatively unregulated. You see, regarding art, it does make sense to have few regulations only for various reasons. I mean, how would you compare the value of a piece by Master Wu Bin with a Rembrandt? Regarding the financial side of the art market, it is a different story though. The stock market, for comparison, has a lot of regulations for a reason. Thus, things like the rather recent 5th EU Anti-Money Laundering Directive in the art world, the AMLD5 or short 5AML, they really are only the beginning where governments realize that an increasing number of people cross the boundaries between art and finance. One of the difficulties with the art market lies with a few having a lot of say over everybody else. But potentially because of that, it is not uncommon too that fairly simple price manipulation tactics were used over time to inflate prices of art pieces. Now that is the art market. However, you don't need to directly partake in the art market yourself if you want to use art as an investment tool. So is it worth it? Now, to understand what could be worth an investment, you will look at what pieces sold at what price, when and where. Thus, you want an index to track these pieces over repeated sales to see how their worth developed, either for a price or for a school of art, a style, a period, whatever is of interest to you. The Moses May Fine Art Index or the Art.com Art Index are such indexes. Moses May took thousands of repeatedly sold pieces from New York auctions and then tracked their price development over time. There are, of course, problems with such indexes. It starts with the questions such as, what price do you take as a reference? Net, pre or post gallery fee deduction? What about the private sales? What about bidding wars or exclusive auctions? Taking the art market report and such indexes side by side, we may conclude that we both need quite a lot of money to make art investments work, and also quite a bit of strategic buying of certain artists only. Everything else is less promising regarding returns. Now, for most parts, we see that people who have the money to invest in old masters that are, in fact, seeing the continuous appreciation and increase in value, they will do so. And we're talking about maybe 200 artists worldwide that really fall into that category. and maybe 100 or fewer artists that will persist any economic downturns and increase in value over time. A lot of Western art history-based masters are in this list. Like a name like Picasso, Van Gogh, Monet, Gauguin, Klimt, a few modern artists, plus specific cultural heritage items from around the world slowly join the ranks, and they are of interest. A large portion of the art world sales depend on marketing, exhibition, economy, networking, and even whether the Google algorithm favors them or not. So these indexes, therefore, they leave a grand majority of living artists out of the loop. But let's put a pin on that for a moment, and let's go buy art and then own it anyway. So the very traditional way does not need much explanation, I think. You buy a physical art piece and you can sell it at a higher price again. The catch is, this is rather expensive, as you need to transport the piece accordingly. You need to store it under proper conditions, like having the right air humidity and temperature in the room. You need the proper insurance. You need experts to log the provenance and other things that come along. I do neglect tax-based investment strategies and such for a moment here, as this is a different topic of interest. But because of these high costs, most smaller art investments in physical arts result in a net negative, because the profit of the transaction is not large enough to cover all the tremendous costs of storage and insurance and such. Now let's look at digital art then. If you want a crash course on what an NFT is, by the way, I explain this in a video very simplified, go check it out. With digital art and tech such as NFTs, investment strategies in art portfolios come more into play, where you don't own the piece in a physical location. That is a lot cheaper regarding storage and transport. Now, the same goes with owning a physical asset that you tokenize or with fully digital NFTs. With collectibles, that is in the coming as well. We have, for instance, the German-based Timeless.investment that buys a variety of collectible items like sneakers and cars and then tokenizes them for their members. Or we also have galleries on marketplaces, such as OpenSea or SuperRare. We have fashion designers that release limited items, games that have game items as collectibles, up to guys that tokenize art, already 10 years ago. There are many ways how to do that, and if you own an NFT, you can go to the secondary market and resell the NFT, and also earn from future reselling for royalties without the storage and all these kind of costs. If you know your market a bit, playing with royalties, for instance, can be very interesting for you as a form of long-term investment as well. Think about fan art or design studies and so. Pump EQ does this as well. On their page you can buy their NFT, which they use to create children's books, and in return you may get small royalties from the sales of the books. Now, but let's also put a pin on that for a moment and get back to physical art. So physical art investments can be interesting, but they become more interesting if the volume increases. And for most parts, anything below $1 million will not be worth the investment if you focus on the ROI. So thus people created funds to share the monetary burden and then let other people buy into these funds. So people invest into art without owning the pieces directly, and someone else owns them for them. Investing in art without owning means investing in a fund, an index, to give loans for a collection, buying shares or equity from an art-related company, buying tokens, fractions, and so on. So you give money to someone who owns the piece for you, and they sell it at some point, and in return, they can reduce the risk of a bulk loss. Depending on how you frame your approach, a lot of different models fall into this category, but the idea stays the same. A single entity buys a piece, creates a sort of fund or so that people can buy into, and when the entity makes profits from selling, the shareholders may get a potentially positive return. Now, why would you want to do it like that? The reason you would want to do that is predictability. As we said before, there are many factors that change whether you can sell something or not and at what price. And Scott Lynn of Masterworks says, if you invest sums larger than $1 million into art, you can start to play in a field where you can make predictions about the return because the field is so small of which artists there are and which people value to possess such artworks. The big collectors basically know each other. Knowing this, what Scott Lynn did then was an interesting approach. He created a portfolio of arts that he calls Masterworks. And let's look at this. So Masterworks.io creates a fund to buy artworks, just like the London Fine Art Fund or the Boston-based Fernwood Art Investment Fund. But the difference is that you do not need to lock your shares like with a normal fund, but you can buy and sell the shares on their internal platform. What Masterworks does is, in one way, quite a fascinating idea and also a bit mind-bending how exactly that they work. Now, to be clear, this is a third-party broker platform. It's not registered and listed, and I'm also not affiliated. And I want to break it down for you. So Masterworks Gallery, an affiliated entity of the platform Masterworks, buys the piece via a registered broker and then creates an LLC out of the artwork. So they vest the art title via third parties and a subsidiary in the Cayman Islands. With this, they can create equity shares just like a company would. And you as a client on the Masterworks platform buy then these shares on their platform. They then look to sell the pieces at a higher price and you get a payout proportional to the shares that you own, which makes your investment to Masterwork more a buying shares from someone that trades on art via third-party company construct. Now, if you remember earlier, I said you buy into the fund of one entity that buys the piece for you. And the main one fund giver here is Scott Lynn. So in a very simple way, Scott Lynn has money and he lends it to company Masterworks. Masterworks buys art pieces and creates little companies out of it. You buy equity of these companies, which pays back the loan that Scott Lynn gave to the entire construct. And how does this work? Masterworks claims that they invest in blue chip art only. And blue chip art is a term coming from the stock market and it has nothing to do with art. In the stock market, you call the top performing stocks blue chip stocks. So people merely adopted the term for the 100 top performing artists over a set period in terms regarding investment return. So Artprice.com used this term early on, I think. They created an index and Masterworks built on this idea and then took it one step further. So Masterworks datafied what they could find that had been sold through public auctions. All returns that Masterworks offer to you are based on these estimations over a historical price development. So basically based on a mix between the art price indexes and their own interest, their own strategy, access, network, and research. And that gives you an estimate of the return to your investment per year that they expect. Masterworks presents that potential to you using a lot of pretty graphics with forward-using language and nice curves to illustrate how your investment may rise over time. I do say illustrate because, as they explain on the platform, they use a lot of fictional representation to illustrate the data and the potential return over time. And why is that interesting? Well, it's targeting a specific audience. See, how do we factor economic development, a global pandemic, trends, inflation, new regulations like the 5 EML, but also degradation, various other factors into an investment that does neither work nor create output or products on its own and entirely relies upon its selling price? Well, we don't. Thus, receiving return propositions in a market that changes what is in vogue each quarter and where the prices are made in auctions, depending on what is being sold, where and when, and then displaying it illustratively in a way to market it is interesting to me, to say the least. Yes, they have a disclaimer where they explain all of it. So Masterworks presents you with potential investment graphics and data based on such selected examples of pieces, so that you understand it. As mentioned before, arts don't give return per year, but financial people can't invest into something that has no number on return per year or ROI. To simplify it down to the finance people with limited knowledge and novice investors, Masterworks creates these estimates that are more understandable to them. At least that's what I assume, that's why they do it. What I personally criticize is that as a non-regulated LLC, you have no equity say in when or how much the art pieces are being sold off. I would not quite call that democratizing art the way Scott Lynn labeled it in his video. But let's offer the benefit of the doubt, and maybe they disclaim all of it somewhere and I just could not find it within the forest of disclaimers within disclaimers. But having said all that, the Masterworks idea is one interesting way of investing in art, and in some regards I have to offer my respect to the team that managed to actually make this construct work. It is novel and novel things are never easy. So let's come to a closing. I believe that the art world is currently undergoing a change. The tokenization of art and the underlying blockchain technology, the protocols, and ultimately the whole approach of decentralization massively changed the art landscape, and with it, authorities became more interested in it. This will presumably make the financial side of the art market a lot more regulated over the next 10 years. At least I assume that. Oh, yeah, what do you think? See you next time, and thanks for watching. Bye.